We envision a soft landing, a slowdown of global growth, but no global recession. But of course, global financial stability is not so much about the baseline, it's more about the downside relative to the baseline. So today, we still have fairly elevated interest rates relative to the recent history, but we also have some increase in credit realization. So default rates are going up to some degree. Again, a lot of heterogeneity across countries and what kind of exposure you have in different sectors. But for example, commercial real estate, in some countries, residential real estate. So it's not only the rates, it's also credit that is weighing on some institutions. Right? In particular, in an adverse scenario with a flare-up of inflation, higher for longer interest rates, and a sharper drop on real activity, there's a weak tail of corporates, there's a weak tail of households, and a weak tail of banks, you know, pretty much around the globe. You know, how fat the weak tail is depends very much on the country. In our assessment, you know, the actions of the government have been, you know, very well targeted in terms of providing support. I think that this targeted support has helped cushion and mitigate the fallout in terms of financial stability. Now, having said that, of course, there's some uncertainty as to how much further property prices will adjust, and you know, to what extent those losses will be allocated across different agents. So we're watching the evolution very carefully, but as you allude to, we share the assessment that it's not so much of an acute financial stability risk because of these actions that have been taken. It's more of a structural transformation in terms of shifting the growth model and rewiring the real economy. And of course, the financial sector will then appropriately adjust as well. The degree and the speed to which countries are moving towards carbon pricing, you know, remains somewhat worrisome. And so we are doing also quite a bit of work on climate finance. So basically complementing the fiscal with the financial. And of course, Hong Kong has been a leader in terms of issuing green bonds. So, you know, our question is, to what extent can we help the membership, you know, thinking through climate financial arrangements in order to finance the necessary investments for a green transition, both in terms of mitigation and adaptation. So I think the climate information architecture is extremely crucial. So this has really three parts. So one is data about you know, scope 1, 2, and 3 emissions. Secondly, disclosures about that data. And thirdly, the classification, or we sometimes call it alignment. We do see benefits of tokenization. We do see benefits of CBDC, but we also see risks and potential sources of instability. So, you know, what we are trying to do is really help central banks around the world think through both the costs and the benefits, and to appropriately, you know, assess both risks and opportunities. Capital markets work well when they are liquid and deep and broad. So fragmentation of liquidity is one potential risk. You know, secondly, there could be you know, abrupt portfolio flows that could be disruptive for countries relative to some shocks. So not closely tied to market liquidity, but tied to, say, political developments or so. So last year, we looked at those issues quantitatively, and we do find already in the data that we can see that fragmentation has an impact on portfolio flows, and that has an impact on the cost of credit intermediation in countries. I would argue it's the macro fundamentals together with the institutional capacity to sustain a healthy environment that can attract capital flows. I think Asia is such a good example. We have so many countries in the region that have seen a tremendous development in terms of capital markets, in terms of attracting foreign investment, and helping to sustain sustainable and long-lasting growth. And I think many other countries can learn from the Asian experience. Extremely impressive. And I do think, well, we started the conversation, which is, the environment for financial stability, the resilience, and the macro framework is so important to create an enabling environment to attract capital flows.